Building out a retirement income plan is stressful for most of you, and I want to talk about the types of retirement income sources that you may have and give kind of my 2 cents on each one and how they need to fit into your overall plan. A lot of you look at these things as individual silos, and we need to look at it as a whole and all-encompassing type of income flow. Again, a lot of the conversation to this point for you watching this video, through the last 20, 30, 40 years of your life has been accumulation. How do we save this up, make the money work for you, build, 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 build? At the end of the day, we need to actually draw it out. Like, we're building this thing up to draw it out, not to kind of keep going forever. Maybe some of you are, but most of you aren't. And so we need to draw this out. So what are the income sources? How do they work? And a few tips on each one to make sure that you're maximizing them for your retirement. The first one is maybe the most obvious, and it's the Canadian Pension Plan. And this will be for any of you that have paid into the Canadian Pension Plan, CPP, you will get some payment out of it. And the Canadian Pension Plan is a very important tool as part of your retirement plan. Now, it's in a good position, much different than the US. The Canadian Pension Plan is a very well-funded investment. You put money into it, your employer kind of matched along the way, and you will get a payment out of it. And we have tons of videos on this channel on CPP, when to take it, how it works, all of that. So I won't dive into all of that. But remember that your Canadian pension plan increases every year with inflation. So the last few years where we've had a higher inflation rate, your bumped CPP has also increased with that as well. So it's good that way. Now, again, you can defer it from 65 to 70 or take it earlier. Again, watch some other videos on that to figure out what the best solution is for you, and that needs to be incorporated into your overall financial plan. The second payment you're going to collect from the government, now CPP you paid into and you're going to get a benefit out of it. Old age security, or OAS, is something that you will get payment at 65 or 70, depending if you defer it, but it's based on how many years you were in Canada. So as long as you were in Canada for 40 years, by the time you turn 65, you will get 100% of old age security. If you're here for 20 years, you'll get 50%. So again, it's not based on anything you paid into it, but how long you've been in Canada. You can start old age security at 65 or defer it till 70 for an increased payment amount. Again, we have lots of information on old age security, payments, how it works, OAS clawback, all of that on this video, so check out our other videos on that. The third type of income stream you might have in retirement is an employer pension plan, and I'll break this into two categories. The first one is a defined benefit, meaning that when you retire, you get a set payment coming back to you. Typically, these also are adjusted to inflation, sometimes not, sometimes they're. I would say most of the times they're. If you work for a government agency, you likely have a defined benefit pension plan. A lot of private companies used to offer defined benefit plans. That kind of went away 10, 15, 20 years ago to something called a defined contribution plan, meaning that the investment risk and all of that is put on you as the employee, not the employer. And so a defined contribution plan, something you paid into, your employer may be matching along the way, and when you retire, whatever that account's worth, that can be transferred back to you in the form of a LIR or RRSP. Again, everyone's a little bit different, but then you can draw out from there. So again, an employer pension plan will be probably a large piece of where you draw your income from. Again, whether it's a defined benefit where it's a set payment every month, or a defined contribution where you actually have to plan and integrate that asset into the rest of your planning needs. The fourth retirement income stream, and I would say majority, if not all of you will have this, is an RRSP, retirement savings plan. And this is something that you've built up over time. You've probably put money into it because you were in a higher tax bracket, you were working, you put money in, you got a tax break, and now in retirement, it's time to start drawing money out of there. Money that you draw out of your RSP is going to be taxable income to you. Now, again, remember, you got the tax break going in. And what I find with retirees is quite interesting because they get to retirement, they have to pull money out of the RSP, converts to a RRIF, a retirement income fund. They start pulling out and they say, this RSP, I should have never done it. I got to pay tax on it now. But they forget about the tax break they got putting money in when they were in a higher tax bracket. So they got that return, they were able to do something with that. And the money they put into an RSP over the many years has grown tax deferred to this point. You've only paid tax now later in life when you're in a lower tax bracket. So it's grow tax deferred. Usually for our clients that we put plans together for, the RRSP is typically the largest asset to draw an income from in retirement. Number 5 is the tax-free savings account, the TFSA. And this was an account introduced here in Canada in 2009. And if you haven't started using it, you need to. We're gonna have a video in the next few weeks on this, how Canadians are underutilizing their TFSA. And to me, it's the most powerful investment account out there. You put money in, you don't get the tax break up front like you do with an RSP, but everything goes tax deferred and tax free, meaning that when you take it out down the road at any point, it's absolutely tax free money. And so when we look at retirement planning and leveling out your income tax, or preparing for an emergency payment or a new roof or whatever it is, the TFSA, the tax-free savings account, is such an important account because you're able to access money out of that account on a tax-free basis. So let's say you're going along in retirement, you have a good plan, a tax plan, your average tax rate is very level. You live in a condo building and there's an assessment on there and you need to pay $20,000, $30,000. Well, you don't want to draw that out of your RRIF account because it's going to be taxable. That's where a TFSA could come in. Or maybe you have a big trip to Europe planned and you're going to need a big lump sum, or you're doing a family vacation and you need a lump sum. Anytime you need kind of that bigger lump sum, like where do you get that from? Maybe it's a new vehicle. A TFSA account is a great tool to have as you enter into retirement to create that flexibility around your tax situation. The 6th income source you may have, a lot of you don't, but some of you do, and it's a big piece of it, is annuities. Now, a lot of you may have an annuity because someone left you money in a will and it had to go into an annuity. We've seen that many times. Some of you had an older spouse and they had some money and they bought annuities for you to make sure that you were taken care of for the rest of your life. There's different reasons to buy annuities. I'm not a huge fan of annuities myself, but more recently with interest rates going up, they may start to make more sense going forward. Again, typically it's a piece of the pie. If it is any part of the pie, you want to review that. But if you have an annuity, it's a great guaranteed income source for the rest of your life or the period that they bought it for. The next 2 I would say are more controversial and more conversational in that people have different views on this. And the first one, number 7 on the list, would be dividend income and investment portfolios. And I want to focus on dividend income. As you enter into retirement, hopefully you have an investment portfolio that's maybe generating some sort of income, dividend, interest, some capital gains in there or whatever it is. But the dividend and interest income is good because it generates some cash flow that you're going to need to pull out as part of your income, right? You have no more paycheck when you retire. You need to have some cash flow. So if you have a cash flow plan generating some dividends and interest income, it eases off how much asset you need to sell to give you the overall income that you need. Now, there's 2 ways to look at this dividend. One is buying a company like Microsoft or FedEx or Johnson & Johnson or RBC or TD, you name the company, that pays a dividend. Maybe it's 3, 4, 5, 6% dividend. So you get part of your return on the dividend that it pays, and then part of the return hopefully on the stock price going up over time. So there's kind of the capital gains exposure to it and the dividend exposure. 2 ways to kind of draw income out of that. That's a great way to do it. That's how I invest myself. That we find that's a great kind of system for retirees to kind of get a nice consistent cash flow from these big companies that typically have a good profit. Now, the second part of this is a lot of you have dividend income, but it's kind of the high yield dividend. And you say, well, I'm collecting 10 to 15% dividends or payment or interest or however you want to term it on your investments. And this is a bit different because what happens is you have a leveraged investment that's producing much more cash flow than it can maybe do long term, depends on what you're invested in. So it's getting maybe 10, 15%, but your cost based on your initial investment, your NAV, is reducing over time. So you might be getting 10 here, but you're losing 2 or 3 here, so your net is 7. So again, as you kind of create your retirement income, and we've done a lot of financial plans for people that are invested in this like high yield passive investment type investments. And what we're finding is most people don't understand how these investments actually work. They get into it because it's the shiny sticker of, hey, you can get 10 or 15% rate of return. Again, I'm not for or against that investment. The problem I've seen come through our office is that most of you that are invested in this that we've talked to, and it's been many, don't fully understand how the investment works before you get into it. So dividend income hopefully and probably is part of your retirement income sources, Just make sure you understand how they work before you get into it. The second more conversational one, and it's number 8 on our list, is rental properties. And a lot of you have built a lot of wealth on rental properties. It's been a great investment here in Canada or in the States. A lot of you, when you get to retirement, I'll say this, 95% of our clients, and not just our clients, but other financial planners I talk to as well, typically sell their real estate within 5 to 10 years of retiring. And the reason for that isn't because it's no longer a great investment, but the asset or the net worth of the investment itself. So the equity in that property is worth more than the cash flow it's producing. So for some people, they've built so much wealth that the real estate is just extra. They have enough cash to create the cash flow they need. But for a lot of you that have rental properties, a lot of the cash flow you need to live off of in retirement is kind of locked away in that real estate. And that's why you need to sell it. A lot of you also, you want to enjoy those go-go years of retirement. And to do so, you need a bit more cash up front. So if you're going to sell the rental property in retirement, make sure you have a proper tax plan, timing around like when you're selling it, triggering capital gains, drawing out RRSP, CPP, all that stuff. There's a lot of moving parts. Make sure you have a proper financial plan put together. If you need help with that, we do offer fee-for-service financial planning. We do a lot of plans for people with rental properties and just help them kind of look at, A, do you need to sell this, or B, do you want to sell it? And then when's the timing? Like, how does this kind of all work together to make sure that we minimize the tax bill? Again, maybe you want to hold on to your rental properties forever and just produce that ongoing cash flow. Again, if you're going to hold that till the day you die, what's the plan for that? Just going to be liquidated, taxes paid, move on. You want to talk through that with your financial planner as well. The 9th and final income source you will have is savings. And a lot of you will have some savings on the side. And right now, it's a great time to have savings because you can get like 5.5% interest on your savings account, which is absolutely bonkers considering a year and a half ago, you couldn't even find 1% rate of return. So it's not a bad time to have a little bit of cash. Make sure that cash is a piece of everything. And the issue we've come across many times is we meet with people, they've been retired for a few years, and they say, you know what, the last 2 years we haven't paid any tax. We've been living on the cash we have. Maybe they sold a property, they got like a severance from work when they left, whatever it is. There's many reasons why they got it. But they're living off of that for the last X amount of years, 2-3 years. They pay no tax. And that's a bad tax plan. I always say you don't want your taxes in retirement going like this. And when you live the first few years in retirement like this, eventually you got to pull out the RRSPs and face the tax bill. And so there's ways to minimize that tax, and living off cash isn't a great way to do it. So just make sure if you have cash, that's great. It gives you that flexibility, but make sure it's encompassed in all of your other assets that you have and cash flow that you have so that it creates an optimized retirement and tax flow plan for retirement. So there's 9 different income sources that you may have. Again, you want to make sure that you look at all your income sources as you hit retirement and make sure they're funneling down to give you the most after-tax money and paying CRA the least amount of taxes you go forward. It's a fine detail to get down to that bottom line to make sure you're paying the least amount of tax possible. Again, talk to your financial planner if you need help with that. We do offer fee-for-service financial planning. Reach out to our office, parallelwealth.com/planning. Happy to help.